The December 2025 silver crash wasn't a real market collapse. It looked dramatic on the surface, and that was intentional, but nothing about it reflected genuine weakness in the silver market itself. Prices dropped quickly. Within a short window, silver moved from the low $70 range down into the high 60s. The speed of the move triggered fear almost instantly. Traders watching charts saw red candles stacking up. Social media filled with panic. People started saying this was the beginning of a larger breakdown, that silver had finally topped out, that the cycle was over. But when markets move that fast, especially during late December, the first question should never be, what changed? But who benefits? Because real crashes don't look like this. In a genuine market collapse, selling is broad, demand vanishes, and physical markets weaken alongside paper prices. Premiums fall, buyers step away, inventories rise. That's not what happened. At the exact same time, Western paper silver prices were dropping sharply. Physical silver in Shanghai was trading at more than a $3 premium over spot. That premium didn't shrink as prices fell. It grew. That alone tells you everything. Physical premiums don't rise during real crashes. They rise when supply is tight and demand is urgent. And demand doesn't surge unless buyers believe prices are temporarily distorted. This wasn't fear-driven selling. It was mechanically induced selling. To understand why this happens, you have to stop thinking like a retail trader and start thinking like a global bank. The largest banks in the world don't manage risk the way individuals do. They don't react emotionally to price movements. They don't panic. They plan months in advance. And their most important date every year is not an earnings call or a CPI release. It's December 31st. Under Basel III regulations, global systemically important banks are evaluated using balance sheet snapshots taken at the end of the year. Whatever risk they are carrying on that single date determines how much capital they are required to hold for the entire following year. Capital that is locked up cannot be used elsewhere. It doesn't earn returns. It doesn't fund growth. For banks operating at massive scale, even small changes in reported exposure can free up enormous amounts of capital. So every December, these institutions do the same thing. They reduce exposure, close positions, and make themselves look smaller and safer than they actually are. This process is not about market direction, it's about regulatory optics. Silver, like other commodities, sits directly on bank balance sheets through futures, options, swaps, and structured products. Throughout the year, banks profit from these positions. They provide liquidity, hedge client exposure, and earn spreads. But when December approaches, that exposure becomes expensive. So banks unwind. They sell paper contracts aggressively, often into thin holiday liquidity. Volume is lower, fewer participants are active. That makes prices more sensitive to large orders. When a major player sells into that environment, prices fall fast, not because buyers disappeared, but because liquidity temporarily did. This is exactly what happened in December 2025. The selling pressure wasn't random, it was concentrated, it wasn't emotional, it was deliberate. And it wasn't responding to new information, it was responding to the calendar. While paper markets were being pushed lower, physical buyers were watching closely. Manufacturers, refiners, and strategic buyers in Asia don't operate on the same incentives as Western financial institutions. They don't care about December balance sheets or regulatory snapshots. They care about securing supply. When they see prices drop without a fundamental reason, they step in. And when multiple buyers do that at the same time, premiums rise. That's why Shanghai premiums exploded during the sell-off. Physical demand didn't weaken, it intensified. This creates a one-way transfer. Paper sellers reduce exposure. Physical buyers lock in metal. And once that metal moves into industrial supply chains, it doesn't come back to the market. By early January, the pressure lifts. Reporting deadlines pass. Banks are free to rebuild exposure. Liquidity returns. Prices stabilize and often rebound. From the outside, it looks like volatility. From the inside, it's a planned reset. This pattern repeats because the incentives haven't changed. And it's not unique to silver. LIBOR manipulation followed similar logic. Banks adjusted reported numbers around key dates to minimize regulatory consequences. Treasury market disruptions have repeatedly occurred near balance sheet reporting periods. Gold experiences similar December behavior, though silver's smaller market makes the effects more visible. Regulation didn't remove manipulation, it reshaped it. Instead of constant distortion, it created predictable windows where distortion becomes optimal. December is one of those windows. What made December 2025 different was the scale and the context. Industrial demand for silver is already under pressure from structural supply constraints. Mine output is not growing fast enough. Recycling is limited. Strategic stockpiling is increasing. At the same time, silver's role in electronics, solar energy, electric vehicles, and defense systems continues to expand. This is not speculative demand. This is structural demand. So when prices were pushed down, buyers didn't hesitate. Western banks reduced capital requirements and optimized balance sheets. Asian buyers secured real assets at artificially low prices. That difference matters. One side was focused on accounting, the other was focused on ownership. Financial media won't explain this dynamic. They'll use vague language like holiday trading conditions, technical corrections, or profit taking. Those phrases sound reasonable, but they explain nothing. They won't talk about Basel III. They won't talk about year-end snapshots. They won't explain why physical premiums surged during a so-called crash. Because once you understand that, the narrative stops working. And here's the most important takeaway. December silver crashes are not warnings. They are signals. They tell you when paper markets are being forced out of alignment with physical reality. If you understand the cycle, you don't panic. You watch premiums. You watch physical demand. You understand timing. If you don't understand it, you repeat the same mistake every year. You sell into weakness, you react emotionally, and someone else buys what you gave up. This isn't about predicting prices. It's about recognizing structure. And this structure isn't going away. As long as banks are regulated based on reporting dates, as long as commodities sit on balance sheets as risk, and as long as physical demand remains strong, this pattern will repeat. December after December. The December 2025 silver crash wasn't real. The recovery wasn't accidental, and the wealth transfer wasn't luck. It was engineered. And the people who understood what was happening didn't panic. They waited, and they bought.